Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. Going to be sharing some articles with you today that going to help you kind of get a handle on some things. Now that we've passed the election, I know I've talked to a lot of people that have been very concerned of what the impact of the changeover would be. How might it affect the stock market? So far, so good. It hasn't had a real negative effect. Partly because I think the market has priced in a very hefty stimulus package in terms of how it views at least the immediate future or the next even 3 to 6 months. After that, though, it's kind of like a sugar high. Okay. After that, what happens? What happens when the basics come into play as far as the economy and the market itself, as far as how profitable it's going to be? Is there, in fact, a little bit of a bubble? A lot of concern about overvaluation of the stock market, as well as that of the real estate market. When we've seen prices, I've talked to a number of clients that have considered relocating or either downsizing or maybe even upsizing or just changing where they're at, where they're living currently, and finding that they've got a real difficult situation because the cost of housing has gone up. And it's still very much a seller's market, and running into situations where you find a house and there may be 2 or 3 other offers on that house. A lot of cash offers, a lot of folks coming from out of state to move here. So all of these can have an impact. How is that? And of course, when we're talking about real estate, it's not just here. We see that one, of course, in the area we're in. But, you know, around the country, we see that real estate prices are up as well. One reason for that, very low interest rates. People tend to buy payment as opposed to price. So it's not what the house is necessarily selling for as much as how much is it going to cost people per month to be able to get a mortgage to live there. So these are all considerations that have caused housing prices to go up. Again, are we going to see anything like we did back in the financial crisis? Are we going to have any kind of bubbles that might create a recession potentially, or a bear market coming? So these are, you know, certainly corrections are standard, but what might this look like over the next year, and in particular over the next 2 to 3 years, as we get into the new administration and some of the policies start to take effect, and what impact they may have? In fact, some of the things they've talked about is raising taxes. How might that affect the markets? How might that affect the economy? How about, you know, if they raise corporate taxes, are our domestic companies going to be able to be as competitive in the world if they're paying higher taxes? In particular, if those taxes are higher than foreign companies pay. That gives them an advantage, doesn't it? There's so many different policies, regulatory issues that could come in that could have a negative effect with regard to our corporate environment, businesses, and therefore the stock market. And for all of us invested in the stock market through our retirement accounts, our 401ks, 403bs, our TSP, through a savings plan, guess what? Those funds are not from the government, okay? When you're looking at TSP as an example. So for you federal employees and military, don't get too comfortable thinking, you know, that those funds and somehow are guaranteed. Of course, you have your G fund, and you have some benefit there, much like a stable income fund in a 401k. However, something to be concerned about and something to watch for are some of the policies, okay? Now, what effect they may have on the market, and here's another piece of that. With all the stimulus, what does that look like for the future? You know, at some point that money's got to be paid back. So where's the inflation number that you're going to be using when it comes to your planning and how to do that? You know, this there's an article here called The Hidden Retirement Trap, and, you know, it could cost you, and they use a number of 80,000. Of course, it could be a lot more than that. In this example, though, what they're showing is how much inflation can affect your not just your savings, but more importantly, your purchasing power. So if you're being very conservative in how you invest, in particular if you're keeping most of your money in the bank because you're fearful of the market, or you're worried, or maybe you've been in the market, now you're getting nervous and you're thinking maybe I should get out of the market because of the potential for the market to go down into maybe even into bear territory again. What is all that going to look like to you, and how do you plan for it? Inflation is a big one. You know, they used to have a commercial all the time to talk about high blood pressure being the silent killer. Well, when it comes to your finances, it's inflation that's the silent killer. Do you know how to factor that into your planning? You know, when you're doing your budget, for instance, and you're thinking, okay, I need this much for housing and I need this much for, you know, groceries and utilities and insurance costs that I'm going to have, vehicle costs, all these different budget items. Healthcare costs, of course, are a big one. Do you factor in inflation? You know, and how would you factor in inflation to do so? The biggest thing is understanding that purchasing power can go down. This ties into so many different decisions that you have to make when it comes to planning for your retirement. When you have to think in terms of, I need to make enough money on my money to stay ahead of inflation and taxes, as an example. Okay, another factor that comes into play when it comes to inflation is, what about my income? Is it going to go up? So if I have Social Security, I have cost of living adjustments, right? But how are those factored? And I've got an article here I'll share with you about the difference between CPI and EPI and what that means with regard to inflation numbers, your expenses, how they might go up, and how do you, in fact, keep up with that. So cost of living adjustments typically with Social Security are not enough to keep up with the expenses going up at the rate they do because of the type of expenses you have. And then this is where that CPI and EPI come into play, and I'll explain that. But here's something else to consider. So if I've got inflation to worry about, how do I plan for it into my retirement? How do I make sure I make enough money on my money? And again, on the income piece, if I've got Social Security, you know, we'll have Social Security, of course, how much that's going to amount to, and we'll talk more about Social Security. The other is pensions. If you've got a pension, most pensions are fixed, meaning that you're going to set amount, there's no inflation adjustments for them, no cost of living adjustments. So, and again, even if you have them, it's going to be similar to Social Security, and it won't be enough to keep up with how fast your expenses. All that means is you've got to get more return on your money to be able to do this, okay? And be thinking in terms of withdrawal rates from those dollars as well. I'll give you an example of that with Social Security. So Social Security, we're going to get into in more detail, but think of this. If your Social Security benefit when you retire, okay, is going to be, say, $30,000 a year, that's like a $600,000 asset. Okay, in other words, to provide that type of income for your expected lifetime in retirement, you're looking at $600,000 if you were going to go out and, say, get an immediate annuity that would guarantee that income. So that's how important Social Security can be. Think about that as far as an asset goes. So again, if you were going to get $30,000 a year, that's like having a $600,000 asset. So Social Security is a big thing. All right, big deal. Now, let's take a look. I'm going to show you some basics to get you an idea of how to plan when it comes to retirement. We're going to start with what I call the roadmap, okay? So you need to take a look at things when we're talking about setting up a plan. One of the things that we start with is it's like figuring out what your expenses are, okay? Because we need to weigh what you're going to have for income, expenses, assets, what you have there, and we'll explain how that's going to be important, of course, and in liabilities. So if you think about it, when it comes to first finding out about your expenses, you need to see in retirement, okay, when those wages go away, what are you going to have for your expenses? Your lifestyle expenses are going to, are they going to increase? Most likely, right? We talk about fund money all the time, the discretionary funds for leisure activities. When you have more leisure time, then you're likely to participate more in those leisure activities you enjoy, and that means spending more money. Just like now, most of the time when we're enjoying our leisure activities is on the weekend. That's when we tend to typically spend more money. Okay, now if every day is going to be a weekend, okay, then that likely we're going to be spending more when in particular in those first 10 to 15 years of retirement. When we're younger, we have our health. What we mentioned, Tom Hegna, the economist, who refers to those as the go-go years, when we're typically going to travel more or be more involved in leisure activities and other things we may do. We may get more involved with our church. It may be about mission trips. It could be any number of things that we tend to do, and likely we're going to need additional money for that. So then, how do you put all that together? So let's take a look at, this is a tool I use. We call it the financial roadmap, and it's kind of like the foundation or basics of a good financial plan. So what we start with is your operating fund. So first we need to determine, well, what do you have for living expenses? So we fill out that lifestyle expense worksheet. Basically, we're not looking, this isn't a budget exercise, okay? Some people use it for that, or at least it becomes that when they see where their money's going. They may say, wait a minute, I don't want to spend that much there. But the goal of it isn't to look at it as how much you can get by on. Okay, we don't want to just get by, right? It's not about surviving in retirement. It's about thriving. It's about having fun. It's about enjoying those years. So what we're doing is we just want to identify what your current lifestyle is that you enjoy. You know, how much you're able to go out to eat, for instance, how much you enjoy, if that's one of the things that you enjoy, whatever hobbies or other leisure activities that you might have. You know, what do those cost? Vacations. We want to factor in tithing, charitable donations, clothing, personal care, haircuts, nails, all the different things that we spend money on. Maybe you like going out and, you know, therapeutic massage. Maybe you like to, you know, to do that on a regular basis as a means of keeping your health and emotional stability and everything up, right? Maybe it's, you know, whatever it is for you. We want to factor all that in and identify how much, and then break it down, all those annual expenses, break them into a monthly one. And now that's my monthly expense. Now I want to have at least 1 month, my operating fund, with, you know, your regular checking account. So if I spend $5,000 a month, I want to have $5,000 in my checking account. If I spend $10,000 a month, I want to have $10,000 in my checking account, and so on. So it's all relative to what your expenses are. Next comes the emergency fund. And that operating fund, by the way, you're wanting to have that running balance, so when bills are coming in, you're paying the bills as they come. You're not waiting, you know, waiting for a check kind of thing. We want to get away from that mentality, if you've been there and when you're first starting out, where it's that month-to-month thing, to where we're living a little more a little more elegant lifestyle here, if you will. So next comes the emergency fund. Here you want about 6 times whatever those expenses are. So again, if it's $5,000 a month, you want $30,000 in your emergency fund. If it's $10,000 a month, then you want $60,000 in your emergency fund. And these are funds, both your operating fund and your emergency fund are liquid accounts. You want to have them in checking, savings, maybe a money market, that kind of thing, where you can get access to them right away as needed. The next comes is your short-term fund, and this falls into the same category as far as checking, savings, money market. Possibly you might get into some short-term like CDs or short-term fixed annuities if you've got a short-term fund for, say, you're going to get a car in 2 years. You want to put the money aside. You don't want it invested subject to market losses. You want to have it set aside again in one of those other instruments, savings, checking, money market, or short-term fixed instruments like CDs and fixed annuities. Whatever, just to get, we're trying to get as much interest as we can, and of course in this interest rate environment, plus side, if you're looking to borrow money, is great because rates are really, really, really low. But if on the other hand you're trying to invest safely in bank things or things where you get guarantees, then that's the downside, is it's very difficult to get any kind of return as well. As we know, checking and savings and even money markets pay no interest or fractional amount of interest, if any at all. And even on the short term with CDs and fixed annuities, you're probably talking, depending on how long a term, 1, 2, 3 years for instance, you may be talking 0.5% to maybe 2%, 2.5% at the outside. So, but that short-term fund, your emergency fund, and the short-term fund, by the way, is one that you come up with based on expenses that you anticipate, planned expenses, if you will, over the next, say, 2 to 3 years. So if that were getting a car or home renovation or maybe a big, you know, once-in-a-lifetime, you know, trip around the world or whatever it might be, you want the money for that set aside in a short-term fund. All right, so the difference between the emergency fund and the short-term fund: emergency fund, unplanned expenses. We don't know what's going to happen, but something always does, unplanned, and we want the money readily available. Planned expenses is a short-term. That's one we know we're going to spend that money at some point in the future, and we'll put that together. All right, we're going to take a break. When we come back, we'll jump back into this, and I'll explain about the long-term fund, how inflation works. So there's a lot to tie in here, but I'm trying to put a bunch of things together for you today that's hopefully going to help you in your planning. But first, a break. Join me here. We'll be right back on the Retirement Report.